The government's economic objective is to improve the well-being and the living standards of New Zealanders through a sustainable, productive and inclusive economy. Monetary policy plays an important role in supporting this objective. The Reserve Bank of New Zealand manages this monetary policy while promoting the maintenance of a sound and efficient financial system. In regards to the policy framework, one of the key elements the Reserve Bank has at its disposal is the Policy Targets Agreement. The PTA was created stressing the importance of clear policy objectives, assigning responsibility and providing clear lines of accountability when meeting these objectives. Under the Reserve Bank of New Zealand Act 1989, the PTA must be tabled in Parliament, and therefore a public document. Historically, the policies are in mutual agreement from both the Finance Minister and the Governor of the Reserve Bank. These policies allow the Reserve Bank to carry out its primary function of conducting monetary policy to achieve and maintain stability in the general level of prices. This price stability is defined in regards to the All Groups Consumer Price Index, measuring the change in price level for household consumer goods and services. In March 2018, the PTA was ratified to focus on specific targets relating to the medium-term timeframe. These new policy targets were for the Reserve Bank to use its available mechanisms to maintain an annual CPI inflation between 1 to 3% and national inflation at around the 2% midpoint. One of the major changes to the policy is the use of the target mechanisms to contribute to supporting sustainable employment within the economy. At the same time, the government has proposed to amend the current legislation so that monetary policy will be created and implemented by a committee consisting of internal and external members of the Reserve Bank.
Having monetary policy and regulation so it sustains employment within the economy is a good thing. But while it might seem that the bank is widening its mandate, it seems to be in sentiment only. For two reasons. Firstly, by providing an environment of stable inflation as its primary mandate, it is by proxy creating the best way to provide stable employment outcomes in the greater economy. By addressing the issue of employment outcomes as an individual issue, it seems more of a formalization of the bank's underlying mandate. Secondly, in regards to monetary policy and its effect on unemployment, it has been found that medium to long-term monetary policy affects nominal variables such as inflation and nominal GDP, but has been shown to have little impact on real variables like unemployment. While this might be the case for medium to long-term policies, there is a contrast when compared with its short-term counterpart. In the short term, the effects of monetary policy have historically shown a lower degree of unemployment than its longer time-frame counterparts. While we might believe that all discretionary choices about monetary policy are simultaneously choices about both inflation and unemployment, employment outcomes simply aren't the relevant variable for medium to long-term monetary policy. Although they might tell us about other areas of labour markets, tax effects, and retirement income policies, unemployment rates are established upon information that is often incomplete and is a figure that economists find hard to distinguish outright.
While the ratified PTA establishes that current policy objectives are set out by the Minister of Finance, there is legislation drafted to enable a committee-based board of internal and external members to outline the monetary policy objectives. The first concern with the committee is the possible bias from an over-influence of authority. This is in regards to the proposal that the governor should continue to be appointed by the board and that all other voting members, both internal and external, would be appointed by the governor. Noted that these appointments would be made in consultation with the Minister of Finance. There is a possibility that the governor could surround himself, intentionally or unintentionally, with people who will be reluctant to challenge them. The risk is that the minister might raise a few questions about a proposed appointee but will be reluctant to second-guess the governor and cannot overrule him in this model. It is one thing to delegate operational decisions to independent boards, but the members of those boards should be appointed by those who we elect and whom we can toss out. Under the proposed model, there would be 4 insiders and 3 outsiders, and given the information asymmetries, there is a risk that this will favor the governor. We believe that this is the wrong way around. This could possibly create limitations of the outsiders' authority since the insiders could be swayed by internal pressures. If this is the case, it creates the difficulty to ensure transparency and the regular injection of fresh perspectives and alternative views. The second concern is that there is an independence from political influence and the pressures of a limited elected term outlook. The importance of independence of the Reserve Bank lies in the separation of the monetary goals and its ability to implement these instruments without the bias of the government's incentive. Only an independent central bank operating outside the day-to-day business of politics can be considered a guarantor of long-term economic stability. An argument against an independent central bank is that there may be a lack of democratic governance which could lead to poor or biased social outcomes. The New Zealand public need to be confident that an autonomous central bank is working for them, and that is more likely when the decision makers are themselves drawn from the community.
In conclusion, the ratified PDA simply expanded the bank's mandate to include employment outcomes as its focus, rather than fundamentally changing the bank's target agreements. By focusing on price stability through CPI, we believe that the bank was already addressing the wider employment outcomes. In regards to the proposed legislation amendments due with the monetary policy decisions, we disagree with the proposed structure of the committee as it could lead to a potential bias of over-influence of internal authority.